Okay, we've just dealt with office wages where it's an accrued expense. So we've added 1,000 to our office wages, and then we're going to write accrued expenses on the credit side because it's a current liability because we still owe it, and that's for $1,000. Right, now we're going to look at our annual advertising contract of $9,000, excluding GST, was paid on the 1st of August. Okay, so we need to do a little bit of a calculation here. So it was paid on the 1st of August. So let's just draw up our year. So here's the 1st of August, and it's going to last for 12 months, and our balance date is the 31st of March. So that means that it's going to keep going. The insurance is all the way to the next 1st of August. So we need this part for this year. So this is this year's insurance payment, and this is next year's. Okay, so we're going to have to work out how many months. So we've got 1st of August, September, October, November, December, January, and February, and then through to March. So we've got 1, 2, 3, 4, 5, 6, 7, 8 months. So there's 8 months here and 4 months in the next year. So for advertising expense, now it's taken out the GST, so this is what we call a prepayment. Okay, so it's an expense, it's been prepaid. So we need to do 9,000 divided by 12. Divide it by 12 for 12 months and times it by the 4 that has been prepaid. Okay, so you have a calculator, 9,000 divided by 12, $750 per month times 4. So we've got $3,000 for our prepayment. So our journal entry is going to be debit prepayment because it's a current asset, and credit insurance because we want to decrease it by our $3,000. So $3,000 for our prepayment, debit, credit, insurance by $3,000. Oh, not insurance, advertising. The only other one that you tend to get for a prepayment is insurance. Okay, so advertising. So that means on our trial balance, we're going to decrease advertising by $3,000. We're going to put in our prepayment, which is a current asset, for $3,000. Okay. Right, next part. We've got electricity and website expenses are charged 90% to distribution costs and 10% to administrative. So we don't need to do a journal entry for that. It just means that when we do our income statement, we're going to split them. So if we go to electricity, so it's the 7,000 times by 0.9, so 6,300 is going to distribution costs, and the other 700 is going to go to our administrative expenses. And the other one that we were dealing with here was our website expense. So it's going to be 40,000 times 0.9, 40,000 times 0.9. 36,000 is going to go to distribution costs. And that leaves us with 4,000 going to administrative expenses. Okay. Right, inventory on hand with a cost of $7,000 excluding GST has a net realizable value of $3,000 excluding GST. Now, if it says including GST for these ones, you've got to take your GST out to start with. So this means that we are going to decrease our inventory by the difference. So it's going to be 7,000 minus 3,000 to give us 4,000. So our journal entry for net realizable value decreasing is going to be debit cost of goods sold, because that's our expense, 4,000. Credit the inventory because we want the inventory to go down 4,000. Okay, so that in our journal entry, in our trial balance, we're going to increase our cost of goods sold by 4,000. And we're going to decrease our inventory by 4,000. Okay, next one, we've got an invoice on hand. And so we know for an invoice on hand, it's either going to be accounts receivable or accounts payable. In this case, it's invoice on hand for a delivery vehicles expense, including $2,300 including GST. So we know that that's going to be accounts payable because it's an expense. So that means that we need to increase delivery vehicle expense and we need to, it'll have GST and the credit will be accounts payable. So the GST inclusive amount is going to go into accounts payable, so it's $2,300. So we're going to credit accounts payable $2,300. We're going to do the GST exclusive amount into delivery vehicles expenses, so we're dividing by 1.15, which will give us $2,000. And GST is going to be debited by $300 as well. And that's our journal entry. Now we'll make our changes to our trial balance. Delivery vehicles expenses are going to increase by $2,000. So we'll get up to $31,000. Accounts payable is going to increase by $2,300. Accounts payable, we just need the figure, 28,000 plus 2,300 is 30,300. And our GST needs to decrease by 300 as well. So we'll just have 4,000 in GST. Right. Now we've got interest is owing on the mortgage at 6% per annum. The mortgage is due on 30th of November 2014. That's a note. It's a note to our financial statements. Okay, so interest is owing on the mortgage. So we need to work out what the yearly interest would be. So our mortgage rate is 6%. So we're going to take the total mortgage, which is $60,000, times it by 6%. So we'll do 60,000 times by 0.06. So we should have paid $3,600 in interest. So we should have paid $3,600 in interest. So now we just need to look at the interest on mortgage. And we'll do that, complete that in the next video.